When I was listening to the panelists, a lot of questions were coming out. So Vicki, Rodney, Armeer, I hope we have some time for Q&A, because one of the things that you have shown is that there has to be not only intentionality around SETI and inclusion, there must also be intentionality around who the fund managers are, okay? Because this has been a very polite conversation. We could go really hard in the paint on this, but Bill was amazing, and his story is amazing. But let us not forget the difference between Bill and somebody that doesn't look like him is that he could have been on the back of a napkin talking about his company not profitable and get $10 million, all his seed money. The fact that he had to make it be profitable, wait 10 years, and then know his value to get the value is really the conversation. And then our fund managers here, they were polite because the stories that Ajay would have and how he got funded versus our good doctor here are very different. And so this next conversation is why we have and we set these goals and why you are here tonight. So Rodney and Armeer, I want you to bring it. And we're not afraid. Armeer, you are responsible for $200 million, combinations of debt and equity. Folks, pay attention. Because every capital stack, if VC is only 1 or 2%, where do you think the other 98% is coming from? So think about what you've got in the room, the conversations you need to have, the questions you need to ask, and your own intentionality. So let's keep the conversations limited so that we can hear and that you can take advantage of what's being offered here. This is a big commitment for our state. And let's make sure that we get our 5-10-fold return on $200 million. What kind of transformational, generational change would that mean to our state? And if over half of that is SETI, how is that going to change the dynamics of this state? Let's get it. Come on. And I'm done. Thank you.
Going to welcome to the stage back Rodney and Armeer. So, kicking off here, we've gotten to meet Rodney already, but Armeer, the audience has not gotten a chance to meet you. So, if you could introduce yourself and tell us a little bit about what you do. It should be on.
Okay, on. Very good. Good evening. I'm so glad to see all of you here. Armeer Kenchen, and I manage the SSBCI program on behalf of the Rural Center, and I'm so excited to be here. This is full of energy and excitement, and we plan to do some big things for the state, thanks to you all.
Awesome. So I'm going to ask a question first to you, Armeer. So you've been involved with SSBCI since the beginning. You've helped deploy all the capital for 1.0. Y'all have gotten 2.0. It's a lot bigger. So talk a little bit about why 1.0 was successful and sort of what are the key changes in your goals for 2.0?
Okay. Well, I wasn't there quite from the beginning. I came in probably 8 years in. My predecessor, Tom Wall, ran the program, did a great job for a number of years. And I don't know if Patrick is here or not, but he actually tells the story of writing the grant for it on Christmas Eve. So I hear that story all the time, like, I appreciate that. But I don't think he knew then that what it was going to turn into over the years. We got, I think, $47 million in the first round, and we used that primarily for debt, but also for equity as well. And we were able to turn that around more than 3 times. So we've lent more than $90 million in debt and equity, and that's turned over $1 billion in private capital finance. But as Patrick said earlier today, it's only because of our partners. Like, we can't do it. It's not about us, it's about our partners doing that. So This is the perfect example of a public-private partnership. Treasury has capital, has grant money that we can leverage as capital for all kinds of grant and equity, for all kinds of debt and equity. So it's a really great example of a public-private partnership, and it only works because of our great partners. So we recycle the funds more than 3 times, and we have leveraged over $1 billion in capital. Now we got about 5 times more this time, so $208 million what we received, and we're going to try to have the same kind of leverage so we can, and we're talking about a lot of money we want to leverage for the state, and we're so excited to be able to do that.
Thanks. So Rodney, you've gotten involved here with V2.0, with the $50 million in the venture side. What opportunity do you think that provides for North Carolina and economic development here in the state, focus on SETI, and what have you seen work in other states that we can learn from?
Sure. Well, first and foremost, this is actually unprecedented for the federal government to essentially deploy capital to states, and states become limited partners in venture funds is truly unheard of. If I go back in time to the first instance of SSBCI, and I remember, I think I was heard, but not to the degree of being heard today. I participated in a couple congressional hearings around what SSBCI would look like. And SSBCI was an Obama White House initiative that went through the next administration, but then it ran out of money, right? And we didn't really expect for it to be renewed. And it's, I guess, one of the silver linings that, came out of the pandemic with the American Recovery Plan Act. There was some policymakers in there that was like, this is a good program. We need to re-up on this respective program. But if I go back to the original instance, was Senator Mary Landrieu, who was hosting hearings on behalf of the U.S. Senate Committee on Small Business Entrepreneurship. And so I got invited in to the room, and I was really championed for venture. And a lot of states, venture is a very high risk asset class, right? And so given the conservative nature of most state CFOs and controllers, they just wanted to stay away from the asset class. So the fact that North Carolina actually did participate was incredibly innovative. There were a few more states like Maryland, all of their SSBCI 1.0 and 2.0 is going to venture. We see a turnaround happening in Louisiana. Like the first instance, they didn't get that much money. It was pretty much debt. This time around, they got like 110 million. 90% of their money is going in venture. And I think what's happening is you're seeing sort of, capitalists understand that if you've got, 3% of the capital stack that's fueling almost a quarter of the country's GDP, I mean, that's basic math, right? Let's just put more money into that asset class. And so, it was also a good time in history to infuse this capital, because when you look at, Silicon Valley VC and kind of Silicon Valley tech, right now it doesn't appear that they're more interested in really upward mobility of society. They're trying to manipulate Wall Street, right? And that's why you see a lot of these tech companies letting people go. It's not because they don't have the cash on hand. They have billions on hand, but they're trying to manipulate the stock price. And so, prove something to shareholders. And so when they started this talk about, a contraction, this recession, quote unquote, and so limited partners start pulling back. And so funds have had a more difficult time, are still experiencing an incredibly difficult time in raising capital. In comes SSBCI 2.0. And so I think that it has incredible potential. And, if you think about it, I mean, I heard what, Bill said tonight, right? Bill kind of casually said, in and around this program, I hope to attract $100 to $200 million, right? To this initiative. And so 50 can become 200, right? And if you can get to 200, you can get to $500 million, then you can eventually get to $1 billion. So I think it's an incredible catalytic moment. And I'm incredibly excited to be partnering with the North Carolina Rural Center.
Cool. Well, I know that everyone here has been anxious to hear how this really works and what this process is. So, Armeer, can you speak a little bit just about the debt side of the program and how that'll
Sure.
work?
Yeah, absolutely. And so the way it works is we manage, there's 3 programs. And first of all, venture capital is the one we told Rodney, said, Rodney, we know a little bit about it, but not really enough. We need help, right? We don't know what we don't know. So thankfully, Rodney will help us with that piece and build the ecosystem so we can really make some real impact in the state. But we understand debt. So we have a couple of programs we manage with the debt program. We work with banks and CDFIs all across the state to do capital, and we take part in loans up to 20%, 30% of their loans we purchase from each bank. There's a very few key components. You've got to be, first of all, I think the total loan size is $20 million or less. Has to be 500 employees or less. And we got about 45 partners across the state we work with, mostly community banks, CDFI partners, and we come in and we take part in the deal with them. And the whole point is, so for the most part, if you want to start a business with debt, you need to come up with 20% out of your own pocket, right? Equity. And if you got $1 million deal, that's a pretty significant sum of money. And most folks, especially those who are lower moderate income or minority folks, they don't got that money lying around the house. So they can't get a deal done. So we'll come in and we'll say, we'll purchase that part of the loan from you, from the bank, so then the bank has a lower loan to value. The bank can still do the deal. They couldn't do it because the borrower didn't have the money to put down. But if we come in and we purchase part of it, then the bank can get it done at a 75% LTV. They love that. Underwriters love that. So we subordinate. So we say, we'll come in, we'll purchase part of the loan, we'll take the risk, top layer of risk off. And we've done, like I said, we've done over $90 million in loans that way over the past 8-9 years. And so far, tomorrow, we're doing really well with that as well. So we can do that part. We understand debt. We understand terms. We understand how to amortize a loan to make it affordable for folks. But one thing we want to do this time is we want to be more intentional about getting the money out to rural counties, to people of color. We did a really good job 1.0. I'm excited about our impact, but it wasn't good enough. So we don't want to be status quo. I think we did well. I like what we did, but we could do better. So far, we've done over 70% of our loans have been to SETI populations, which is very exciting. Our goal is, I think, 54%, but we have to be very intentional about how to do that. We've got partners here from all over the state, because I think, the Rural Center, we want to focus on the rural counties as well. That's what we do, but also urban counties. So we're spread out across the state, and it's a really good program. Banks love it, CDFIs love it. Ultimately, the borrower gets to keep money in your pocket. You can go get a loan. Don't worry about putting down 20%, put down 5%. Use the rest for working capital to actually grow your business. So it works really, really well. That's our debt portion. Again, with venture capital, we said, we don't know, we don't know. Well, we've done a pretty good job with round 1. We had a 15% internal rate of return. We had 4 fund managers who did a really great job, but we really want to do more than that this time. So we said, let's go out and find someone who can help us get this thing next level.
Cool. Thanks, Armeer. So, Rodney, tell us a little bit about how this venture side is going to work. So if you're a fund manager sitting out in the audience, how can they get involved? What kind of things do they need to know going in? Both the process, the 2-to-1, all of those different things.
Absolutely. So we are deep right now in all of the policy and procedures related to federal compliance and treasury. And it really takes some patience, because if you approach it with purely your innovative mindset and your entrepreneurial spirit, you're going to get frustrated. And when they say the devil is in the details, the devil is in the details. And that's why we're also asking for patience through this process, because we expect a program audit. This is the federal government investing $10 billion, with a large proportion of that going into an asset class that they really don't know a whole lot about. And so we are going to, over the next 2 or 3 weeks, finalize the RFP. And so by the end of the month, we expect to release an RFP. Now, the flexibility that the team at the Rural Center has given us in terms of making this fund-friendly, and I say fund-friendly, but also compliance-heavy at the same time. So If you look at some applications for state small business credit initiative in other states, not to picking on anybody, but Michigan has a 50-page RFP that you got to read just to respond to it. We're looking for responses that are no more than 10 pages. And honestly, we want to see your data room. Like if you talk to fund managers, they spend a lot of time building out their data rooms. And so that's ultimately what we're going to use. So we expect to release that RFP by the end of March. We're still in February, so not by the end of, not tonight, but by the end of March. And Vicki alluded to something that I think was to the tribute of the Rural Center, even before me joining the team, is in 1.0, the federal government asked for a leverage of 10-to-1, meaning as a fund, you had to have $10 under management to apply for $1 under management. So that means you already had to, have had traction and success and access to networks, and that really locked out a lot of, SETI fund managers. And so the new leverage is 2-to-1, and that's incredible. It's not perfect, but that's incredible, and I think you ought to give Patrick and Armeer and Jonathan. Jonathan's here; he's a part of the team back here. Raise your hand, Jonathan. I know he's kind of shy. And the Rural Center team, and Julia, who's not here, who's moved on to another role, but they, you had to negotiate that in your proposal. The feds don't give you anything. You had to negotiate that point of leverage. So the program that we decided to run with is the Fund to Funds program versus a direct investment program. And so the way the Fund to Funds program will work, we'll accept RFPs. We'll keep the RFP open instance one. We're going to do different instances of it, but let's say instance one, we'll keep it open for 30 days. And we'll keep it open really for the next year or until all the capital is deployed. But we really want to be intentional about getting this money on the street. And so we're going to give folks 30 days to respond to the RFP, and then we're going to go through a process of reviewing every proposal. There's going to be an investment committee that's also going to score each of these, and I'll give you the 5, you'll see this in the RFP, but I'll give you a little bit about the 5 kind of areas that will be equally weighted. And then we hope to get the first round of capital out by Juneteenth. We just happen to pick Juneteenth, so some liberating holiday when Texas got a clue. But so the 5 constructs are, so 20%, do you know the region? Can you invest in the region? Can you find deal flow? Because keep in mind, this is competitive, and so it will literally be open to every fund manager in the nation can apply to SSBCI. So there will be out-of-state funds that will be applying, but we do need to make sure that they understand the region and they do have the ability to source deals. Okay, the second thing is around your investment thesis, your fund construction. We kind of want to know, where are you? Are you pre-seed or are you growth, right? That's a huge, you might be mezzanine. So we're actually gonna, allow for mezzanine funds to be in the stack as well. Then we want to look at the team. We want to look at your experience in investing. This is not one of those things where you just have an epiphany, I'm just going to go out and start investing. I mean, you can do that with your own money, but when you do that with other folks' money, they want to get an idea that you kind of know what you're doing. Now, that's not to deter first-time fund managers, because first-time fund managers bring an incredible perspective in what they may lack in investment experience because they don't have the capital. They may have an operating experience. They may have worked in industry, worked in a respective business. You may have a university that has a venture fund or wants to start a venture fund because they want to move capital to alum, or they want to move capital around a certain supply chain thesis as well. But that team stack is going to be important as well. And the next stack, which I think is pretty unique to the work we're going to be doing is we want to look at your diversity, equity, and inclusion kind of solutions. What are you already doing as a firm? What does your governance look like? What does your C-suite look like, or your principals in your fund? What does your procurement look like? There are a lot of different ways to demonstrate your commitment to DEIS, as we call it, diversity, equity, and inclusion solutions. And so we'll be measuring that as well. And then we want to also measure, finally, your ability to reach SETI founders. The actual number that we've committed to Treasury, we've said over 50%, it's actually like 54.12. And I'm not sure how Armeer and the team actually came up with 54. But when I hear 54, what I'm aiming for is 60, right? I want to aim for 60, and if we land at around 50, I think mission accomplished. So we're going to have to select fund managers that can get the money into SETI founders. Now, SETI has a broad, it kind of captures everybody. So you can be in a rural area. You can be in an area that's like been locked out of, and this is a very broad, you're from a region that's been locked out of opportunity, locked out of infrastructure. And then, of course, you got LGBTQIA, you've got veteran, you've got women, you've got Hispanic, African American, Native American. So you got all of the kind of the minority categories there. And so, it's not like, oh man, I don't have any black companies in my portfolio, I don't think I'm gonna make this work. You can still make it work. And that's why we want everybody to apply, because this is an opportunity for you to do what you've been thinking about you wanted to do in terms of making your fund more diverse, because we need all of the capital. We don't want to isolate anybody and say, oh, we're not going to choose any white managers this time. We're going to choose all black managers. No, we don't want to approach it that way. We want to make sure that who we select is committed to the thesis. And that's what we want you to communicate. All money ain't good money, but we're going to choose some good fund managers. And we're going to make sure that those fund managers are able to find the deal flow, because they're going to do the hard work. They're really going to do the hard work. Once we make the allocation, we check a box like we won, But the real work is those fund managers finding those deals that are existing throughout the state. And this is actually a statewide initiative. And we definitely want to make sure that we have coverage throughout the entire state. So that's pretty much the process. I'm sure there'll be some specific questions about that. If we reach the SETI goal of 54%, we unlock another tranche of capital. So the initial venture tranche is like $32 million. If we reach 54% of that money going to SETI funds and SETI firms, we can unlock more to get up to $50 million. And that's the catalytic opportunity where we're actually incentivized from a dollar perspective to just do what's right anyway.
Thanks for that, y'all. So we are winding down towards the end of our program, but I know a lot of people have questions, and y'all came here to learn about this program. So I do want to open the floor to questions. We'll spend about 5+ minutes on questions. And I will, just so it definitely goes over the streaming, I will repeat the question. So if y'all are going to ask a question, raise your hand, I'll call on you, and then I'll repeat the question. All right? Yes.
So what does it mean to the entrepreneurs like us who are just starting a new venture? How does it help, and what is that, if you have any insights, when we should talk, should I really like the fund where they say, so should I tag along to get the funding? So what does that mean to me?
So to repeat the question, what does this mean for founders and entrepreneurs? How do they get started? Do they come to us? Do they come to the investors? And how does that work?
Sure. How many founders in the room? Good, a lot of founders in the room. So, well, one, I would start doing what founders do anyway. If you're an investor, raise your hand. Raise them high. Investors, raise your hands high. All right. Okay? The reason we extended this evening and we got a DJ, we're gonna turn up a little bit, that's just how we do it, is because you can meet all of those people, right? So the convening of the founders and the firms in one place is a good thing. So one, I would start meeting with them and finding out what's your investment thesis to determine, okay, are you pre-seed versus growth? It might be good to know somebody at the growth stage, but they're not gonna invest in you because it's not a part of their investment thesis. So if you're at that pre-seed stage, you're doing that preliminary groundwork, right? When we select the funds that we're going to invest in, we will publicly make that known. So you will know who got SSBCI 2.0 money. The second thing we plan to do, and this will probably be around the same time that we release the RFP, we're going to have a Google form or type form on the Rural Center's website, and you'll be able to go and just complete an application. We're gonna make sure every fund manager that's participating gets your data. So we're gonna help do some ecosystem building and some matchmaking from that perspective as well. So hopefully that's helpful.
Yeah, thank you.
Yes.
Armeer, this is a question. Is it considered double dipping if you are an operating business that is expanding and high growth? Can you also get venture dollars and debt dollars?
So the question was,
When?
can you double dip as a business owner or entrepreneur, and will you have access to the debt side as well as potential investment capital from the VC side?
That's a great question. Absolutely. First of all, so we will connect you with our bank partners, and you've got to go through that to get the bank deal. We'll be there with you if you need help, but that's what we'll do. And we also don't work with entrepreneurs either, so we use a sidecar strategy. So we'll have the fund managers, and the fund managers will go out and they'll pick the winners, which will be all the business folks. I will say this though, yes, that's very possible. I meet probably once a quarter with Lister Delgado, who's here now from Idea Fund. I meet all the time with Tom and Keith from Resiliency, and they are serious about getting capital out to folks who have not had it traditionally, who haven't access to capital. It's a very personal thing. So we take this seriously. So the 54.12%, I said 50%. That's my baseline number. And I went to Jonathan, who's somewhere in the back in incognito. He says, that's not high enough. That's still 54.12%. I'm like, Jonathan, come on, it's not going to be easy. So let's do it. This is serious. So we're very committed to hitting these numbers. This is very important for us. From our fund managers who we work with, like Lister all the time, from other folks in the room. So yes, we're excited about that, and try to be out the box. Why we got Rodney? Because he's out of the box as well. He doesn't like the box. So, but again, we have to stay in our compliance person is on the call. She's on the video. She's streaming. She's watching everything we say. She's our compliance and internal audit person. She's on it. So we're going to be we stick to the rules. We can't go outside the rules, but we can also be very creative in how we do it as well. So we're excited about it.
Other questions?
So you were saying earlier in terms of debt and how you're going to be partnering with banks and institutions, a lot of them don't particularly favor startup companies who are pre-revenue. I understand you guys supporting the 20% down that way, but most of these institutional banking, when it comes to pre-revenue companies, they want sales. Can you talk a little bit about how that's going to?
So to repeat the question, for entrepreneurs, small business owners that are looking to take advantage of the debt side of this, oftentimes banks did not look favorably on pre-revenue businesses. So they're looking for sales, they're looking for proof to actually get the bank loan approved. So the question to Armeer, so how does a business like that, how are they able to take advantage?
A couple ways. First of all, we didn't mention Thread Capital yet. I don't think we did. It's our affiliate. They work directly with business owners, and they can help you with small loans to get a business started. And they love startups. So Thread Capital, Jonathan is the ED of Thread Capital. I think I saw Jaleisha and Shannon here too. You can go to our website and find that information about Thread Capital. But we also have another affiliate called Corner Square. And Corner Square, I think Patrick mentioned it, we were made possible by a grant from Truist Foundation. And we work with CDFIs all across the state and the country. And I think the majority of our loans have gone to startups. So CDFI partners don't mind startups. Banks don't generally like to do startups because it's more risk involved. But CDFI partners can do anything up to $1 million. We haven't seen anything that large go to a startup, but more than half of our loans have gone to startups. And also with LPP and our SSBCI program, there may be a chance there too. So I would not, there's a possibility that it could work. I do know that through Capital, for example, Corner Square, we love startups. And we could look at it as well on our SSBCI side as well. Don't give up. It's a real, I know for a fact that we funded lots of startups.
Yeah, and I think, again, to the team's wisdom to, have this listening session where we introduce this, but also hear. We still have 30 days to go back to kind of frame the policies and procedures around some of the investment thesis. So like what I'm hearing now is, when applications come in, we want to make sure that we pay attention to some of those, real pre-seed investors, folks who are writing those $5,000, $20,000, $25,000, $50,000 checks in the stack, right? Everybody doesn't start off just want to go straight to $1 million raise. Some people want to raise, and then because our community traditionally, for historic and present day reasons, doesn't participate in family and friends, then we've got to figure out how to solve for that. So, hopefully, and I'll just kind of put it out there in the universe that we'll have some funds that do invest at the pre-seed stage to apply to be one of the fund managers.
Good point. Yes?
My question follows up on what you just said. The best and biggest part of our funnel starts right in this room right here. Right. It's accelerators. And they have grant programs. They choose small companies to go through their training. So does any of this involve a grants program where you're supporting these accelerators and good organizations in the state?
So to repeat the question, it's about accelerators. And if you look at the funnel of entrepreneurs, a lot of times they start in an accelerator. And accelerators basically get flow from entrepreneurs, but also support them through grants. And so the question was, is there a part of this program that is set up to support accelerators or grants in very, very early stage, top of the funnel entrepreneurs?
So I encourage everyone in the room to go search at your own convenience the SSBCI guidelines on Treasury. Just make it like your capital formation Bible. Off the top, all of this money is investment money. It's no grants, no philanthropy, it's all investment. That being said, and I was studying, I were talking about this a little bit, there is a provision in the code that does allow for for-profit accelerators that, there's certain, Y Combinator, Techstars, there are different, for-profit accelerators and incubators where they're writing early stage, checks in exchange for small amounts of equity. And so we're going to go back and look at that code and see how we can include, one or two instances of that in the mixes as well. What we have to figure out though is the leverage component of it, right? So if we're asking, an accelerator may not have the 2-to-1 leverage component that a venture fund, they can leverage their existing assets under management and say, hey, we got $2 million, so we're gonna go get, a third more through this program. And so one question and this is an evolving process, willing to take to Treasury is, do you have any more insight on how we could structure an investment into an accelerator, a for-profit accelerator program that's not giving grants, but that's making investments?
Yes?
So to follow up, you were accentuating for-profit accelerators. Is it acceptable if it's a not-for-profit accelerator? Is that already in and included?
As long as you're making actual investments. Right. So let's say theoretically you have a nonprofit accelerator, you select 10 companies and you want to invest $50,000 in each of those companies. You have to actually invest that money on founder-friendly terms, hopefully, that will then contribute, hopefully, some return back to the limited partner, which is in this case is the state of North Carolina, managed by North Carolina Rural Center. So I don't think, the entity. I give you another example. If a university, which is a nonprofit organization, starts a venture fund, they can qualify as well. So you can have some nonprofit entities if they're making actual investments. Now, the venture funds have to be for-profit and have to have that GPLP structure. So even in the case of a university, they'll spin out another entity, right? They won't do it in the name of the university. Yeah.
All right, I think we have time for one more question. So
I love that you said you want everyone to apply, and you really put the emphasis on not focusing solely on one group. I heard Dr. Shante use the term, the illusion of inclusion. And I think sometimes what happens is that that illusion of inclusion occurs because we get focused on one area of diversity and inclusion, but not another. In the fund world, and there are, I saw a report this week that talked about the fact that if you just look at Black fund managers, the bulk of the dollars, 99.9% of the money that went to Black fund managers went to Black men, and 0.003 something went to Black women. So that is part of the illusion of exclusion, because we assume that because we are supporting funds that are led by diverse populations, we are supporting inclusion. And we're not necessarily doing that if women are still extremely marginalized in that process. So how do you intend to address that in this process so that when you put out that list of funds who have been funded, it's not 99.9% men?
So to repeat the question, just to make sure we can capture that, and I won't do it as eloquently as you did, but I will attempt to. So what she said was around what Dr. Shante had mentioned as far as the illusion of inclusion, and the fact that when you look at the funds and investments that have gone to Black fund managers, over 99% of those have gone to Black men, and Black women have traditionally been excluded. So her question is, how is this organization and this process going to account for that so we don't have the same problem exist in the future with this?
We've given that some attention. By God's grace, I'm a 50-year-old Black man. And I came through the 90s when we were told that if we made it to 27 years old, that was something, and we outlived that. And so I understand even my privilege of my affiliation, with being a male. Our intentionality around that is, and we're not going to disclose who the investment committee is by the code, but our investment committee is majority women already. So we already know, like, if you stack the deck with qualified people that look like the archetype of who you want to get capital to, that those qualified people are going to show up and make sure that everybody gets an opportunity. And the one thing I like to say, I've been on committees. I'm on the investment committee of Fearless Fund, which actually, because I'm on their investment committee and a part owner, we've already had this conversation. I'm considered to be an insider, and so that disqualifies them for being able to apply. But when I talk to fund managers around the country, just like, hey, this is coming, it's the women that are excited about it. The guys I talk to are like, nah, I'm just gonna go my own, I'm just gonna, I'm gonna stay the course. So I already anticipate more women applying. But what I do know also is when, and this is just kind of like a macro part of the conversation that needs to be communicated, I think because of the climate of our country and just where we are right now, when Black women are given a seat at the table, they make sure everybody has a seat at the table, right? It's not gonna be all Black women, it's not gonna all be Hispanic men, it's gonna be, and they're gonna be intentional about ensuring that everybody gets an opportunity. So we one step ahead on that one, sister. Thank you.
All right. I'm sorry, but we are going to have to conclude. Rodney and Armeer will probably be up here afterwards. I would encourage y'all to come up. But I thank y'all so very much for your attention. I thank you for your time. And I'm going to let Rodney close it out. Thank you.
So call to action, end of the month, expected RFP. And if you want to be on the list, what's the website? NC Rural Center. But there's okay. We'll keep it simple. If you register tonight, we'll send out a post email.
That's what I was.
So you can go and kind of get on the database, and then you'll be the first to get the RFP, and you'll be in the know. Let's give a shout out to NC Rural Center. Let's give a shout out to Bridget, our Master of Ceremonies, Vicky, who helped to pull all of this stuff together. All right, y'all, let's make history.
Okay, Rodney, I'm gonna be quick. I'm Lori. We'll get together. How you doing? I'm Brandon Campbell, Center.